Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more, all covered now on Life Planning 101.
Welcome into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services out of the big town of Eastland, Texas. Yes, we may be from a small town, but we produce big shows to help people live life on purpose. And I tell you what, that's what it's all about today. Man, I don't know. August 5th, 2024, there's a lot going on in the world. There's a lot of things you can be nervous about. There's a lot of questions about where we're headed, not only just as an economy, but heck, just our world seems to be going nuts, right? And it brings a lot of questions into play. There's no doubt about that. So what we're going to talk about today is the elephant in the room. We are going to talk about the markets because it's too important. There's been a lot of movement over the last couple days, and I think people want to know, what should they be doing? And I'm going to give you a lot of reasons not to invest in the stock market or not be invested in the stock market. And I'm going to give you some good reasons to be invested in the stock market. And before we jump into that, I just want to bring up one thing, because here's what I do know. Just, when people find out what we do for a living, I usually just tell people we try to help people live life on purpose. We help them with their planning, everything from tax to estate to, passing on their legacy to, helping them with their investments. And when they start talking about investments, I get the verbiage of this a lot. I never had good luck in the market, or I've always had good luck in the market. And that's really an interesting phrase if you think about it, because it associates the investment market with gambling, which I'm not saying that it couldn't be considered gambling, because there are definitely ways that you can invest in the markets that it's kind of like rolling the dice at Vegas. I mean, maybe a little better odds. I don't know, but there are some strategies. There are some people that do that on a day-to-day basis. That's not what business we are in as investment advisors. We always talk about we're in the T-ball business, right? We're in trying to help people preserve their legacy and hit the returns that they need to be able to get around the basis to either maybe it's retire successfully and stay successfully retired. Maybe it's to help build wealth and preserve it for the next generation. Or maybe it's just building wealth for themselves at the moment, right? But one of the educational pieces that we walk through with people is to help them understand that there is such a thing as too much risk. And that's the risk that, why don't you just go to Vegas, literally, with that kind of risk, right? Because what we do as those T-ball investors is we're looking for quality, value, not necessarily trying to time the market, but definitely taking advantage of what's going on economically. And I guess the gambling side to that is that we take advantage of what's going on emotionally. Warren Buffett has always been famous for saying, you buy fear and you sell greed, right? So when people get fearful, that's the time that you should be looking to buy. And when people get greedy, that's the time that you should be looking to sell. And I'm going to tell you why, because it all boils down to price, right? If you actually go and try to learn about price to earnings and earnings per share, right? It's broken down in the fact that you have the price of a company, a stock price of a company, and you really associate that with the earnings of that company, what that company's actually making. And then you divide that by the number of shares that they have outstanding. That really tells you a true value in that company. So that's not really like gambling, right? It's not like going put red or black on the table or just betting on a number necessarily. No, you actually have some mechanisms behind there to be able to understand what is happening with these different companies and how they're priced. And if you have the wherewithal, I know this is what my brother does all the time, is he's sitting behind a desk and understanding, from all these different advisors and economics that he's reading and research that he's reading on what's the technology that's out there, of what is going to be used in our economy, how well is it going to be used, and what companies are making this happen and doing it to a great degree, right? They're doing a good job of it, right? They're doing a good job being a business owner in the process, because that's what it boils down to. The market is just one big basket of businesses, right? And we did this article years ago there's a story years ago about if you woke up in the morning and the first thing you did was roll out of bed and you got a water and you filled it up in your mason jar and you went to the bathroom and you went to brush your teeth with your Colgate toothbrush and your Crest toothpaste, and you get in the shower and you wash your hair with your Tresemme, and you've got your Dove soap, and you get out with your cotton towels that came from a store in the mall, right? You start thinking about all your day, everything that you use in your day was produced by a company. Many of those are publicly traded companies. And so you have to ask yourself, are you going to stop doing those things? Because that's really what makes the market stop, right? When the consumers stop altogether. So what is this pricing craziness? Why does this market go up and down like nuts? Because that's what it does. I mean, over the last couple days, if you've been paying attention, you might have noticed a little bit of volatility, just a slight amount. So why does that happen, right? And the market is a forward-looking instrument. It actually looks at how the economy is going to behave. And if things are priced too high, it automatically kind of goes back into the sink of things. So it could be undervalued, can it be overvalued? But over time, the whole thing is it should be in equilibrium to what's actually happening in the economy. That's it. That's all it is. So I know it sounds crazy when we hear the word that, I've had good luck. No, yes, it does sound crazy, because it's not really luck. And the only way that it is luck is if, and I see this with long-term investors, let's say you're saving for retirement. Let's say that you are retired and you're trying to time what the market's going to do within the next 12 months, what the market's going to do within the next couple months, what the market's going to do within the next 3 years or 5 years. That's near impossible. Because that's not what markets are built for. Markets are built for investing for the long term, to help you keep up with inflation and meet your other goals, to build wealth, produce income, build income for retirement, whatever those things are, right? So you can't look at it in a vacuum. You can't look at it in any time in history. It's very, very important. And it's very, very important because if you look at it at any time in history, it's going to scare the tar out of you. And I'm going to give you 90 reasons. Maybe I won't give you all 90 on the show. You can go to the website for this, www.kennedy-financial.com, and you can pull this up this week. I'm going to give you 90 reasons. I'm going to give you a little history lesson on why you shouldn't have invested in the market if you were looking at that vacuum. You're not going to want to miss it right here when we come back on Life Planning 101. Welcome back to Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services. We are talking about the market turmoil over the last couple days and what you should or maybe shouldn't be thinking about. If you are thinking about your investments as gambling, you probably need to get some advice, because there are a lot of reasons at any given time not to invest in the stock market. And one of which, probably the most of which, is if you're looking at it in a vacuum in the short term. And I promised you, we're going to go through a little history lesson, because I think this is so good. We've actually done this a few times throughout the years. I went back and listened to a show that I had done. Gosh, it was back in 2000. I don't know, it was 81. So 81 reasons, we're doing 90. So that was 9 years ago. Wow. 2013 or 2015 when we did it. Right. And the funny thing is we were talking about some of the same things, how our world has gone nuts. And, here I'm a mom, right? I want my kids to grow up in an awesome world. I want them to grow up in an awesome country, and my heart sinks knowing what's going on each and every day out there. And I think it can weigh heavy on you. And the more you're on social media, the more negative news that you see, the worse it feels, because it's just there. It's there. It's constant. It's always there. But what I'm going to tell you is that the 90 reasons that we're going to give you to not invest it in the stock market actually started 90 years ago, because every single year there has been chaos, starting in 1934 with the Great Depression, right? Spanish Civil War in 35, economy still struggling in 36, recession in 37, war clouds started gathering in 38, France fell in 1940, Pearl Harbor was in 41, right? All of these things were happening. And then in 1946, the Dow hit a market high. Now, are you ready for this? The Dow, okay? I just want to put some perspective into this today. Okay, so today, I'm sitting here, it's after close, and on the 5th of August in 2024, the Dow hit 38,703.27. It was actually down, 2.6%. And yeah, it was down 1,000 points. So people look at the points, but really only 2.6%. So we're sitting here talking about the volatility. We'll get back to that. But let's go back to this. Get this. In 1946, the Dow topped 200, right? So that's how much it's grown from 1946 to now. It's pretty impressive, right? And right after that, the Cold War began. How do you think people felt back then, coming out of World War II? Do you think they felt like their world was just a little bit of a mess? Seem a little recent? Yeah. 1953, Russia explodes an H-bomb. The year after that, 1954, this is the year my dad was born, by the way. The Dow topped, get this, 300, another market high, right after the Korean War, right after the excess profits tax started to be assessed in this nation in 1951. You know, people talk about taxes all the time going up. I talk about taxes all the time going up. Nobody wants to pay more taxes. I mean, at the end of the day, yes, you may love your country and want to pay your dues, but do you really want to pay more than your dues? And a lot of people say, no, I don't want to pay more than my dues. Did you know in this country at one time that taxes were over 50%? They're not even near that today. So, you know, it's crazy to look back and think about that. So Dow tops 300 in 1954. Let's continue with our little history lesson here. 1958, there was another recession. And in 1959, Castro seized power in Cuba. The Berlin Wall was extracted in 1961. In 1962, we had the Cuban Missile Crisis. In 1963, Kennedy was assassinated. Yeah. In 1969, the market fell, money tightened. Vietnam War kicked off in the 70s. In 1972, I'm going to hit you with another recent. The largest U.S. trade deficit ever in 1972. Isn't it funny how history repeats itself? We don't pay attention. Obviously, past returns are not indicative of future results. I have to say that when I'm talking about the markets, but we can learn so much from history. It puts things in so much perspective. We feel like we're the only ones going through this, or we're the first time going through this, and there's so much of this that our country, our world has already experienced, and yet we're just going through it again. And so to look at it, not from that vacuum, but to look at it from that bigger picture, isn't it important? In 1973, there was an energy crisis. Gas lines. In 1974, it was the steepest market drop in 4 decades. In 1978, interest rates rise. 1979, oil prices skyrocket. Woo, I'm thinking some modern history here. Didn't we just see that? Interest rates rising, oil prices skyrocketing. 1980, interest rates hit an all-time high, and a steep recession follows the next year. The worst recession continues in 40 years in 1982. Okay, I want you to get this pattern here. 1980, interest rates rise, all-time high. Steep recession begins in 1981. 1982, worst recession in 40 years. 1983, market hits new highs. Wow. So 1984, record deficits again. 1985, economic growth slows. 1986, Dow near 2000. Okay. So 2000, I gotta tell you this. So when I got to start in this business and see, an awesome bull run in the early 2000s. I wasn't quite as old. No, I'm not as old as my brother, no matter how old we look, or I look compared to him. I don't want to hear it. But I didn't get to see that first bear market in 1999 being in the business, but I got to see the financial crisis. And I'll never forget the day when the Dow was in the 6,000s and everybody thought it was going to 2,000. Back in 1986. By the way, it never happened. It stayed in the 6,000s. So in 1986, the Dow hit 2,000. And in 1987, that's when Black Monday happened. Okay, so Black Monday, I want to give a little history lesson in this one because I do think it's important. And one day, the Dow sank back 22.61%. For those who pulled out of the market that day, they were probably not very happy with themselves about a week later because it rebounded. And by the end of the year, the market was up double digits. So volatility is normal. It is normal. And that's why it's called being invested for the long term. It's very important that you're not thinking about what's going on right here and right now. It's making sure that you have a solid investment strategy. You're comfortable with your risk, and also known as your volatility level. What size roller coaster can you feel comfortable riding on through crises, because they're going to happen. Newsflash, economic cycles do occur. We do go through recessions. We do go through expansions. It happens. And it's very important that you're ready to weather all weather. Our job is to actively manage that. We don't say actively get in and out of the market. We actively manage a portfolio to be able to take advantage of various market cycles. Now, does that mean we're always making money? No. Our portfolios do go down. They do have volatility in them. But the goal is to be able to stay invested, because if 1987 is an example of that, I don't know what is, right? Again, past performance does not indicate future results. In 1989, we hit another mini crash. And then in 1989, you also found that you were entering one of the best bull markets ever in history over the next 10 years. In 95, the Dow topped 5,000. In 96, the Dow topped 6,000. After 94, when the Fed raised interest rates, get this, 6 times. Yes. We all remember 1999, Y2 scare, and that tech bubble did burst, and then there was 9/11. We remember the invasion of Iraq, and interest rates started going back up, and we thought we're on the road to recovery when the financial crisis hit in 2008. U.S. unemployment exceeded 10% in 2009. We had a flash crash in 2010 that most people don't even remember because it happened so quick and so fast, right? And then you fast forward a little further, we hit another bull market, didn't we? Over the next 10 years, it was one of the greatest ever as well. And that was through Brexit, which was Britain voting to leave the European Union, North Korea doing nuclear testing, U.S. and China trade wars, Ebola outbreak, impeachment, and COVID-19. And then, if all too recent, 2021, we're back to inflation nation. 2022, Russia invades Ukraine. 2023, Hamas attacks Israel. So what will it be in 2024? Are we staring at it right now? Is it Japan? Is it this flash crash that has literally brought the U.S. markets down to shaking? I mean, obviously this happened a little bit after our bad jobs report came out, and then Russia's going to supply bombs to Iran. There are those little things going on. But just to put things in perspective, did you know that it wasn't until earlier this year that Japan actually hit its first high since 1989? And so we're so surprised that it had the largest one-day decline since 1987. They're having a little bit of volatility, to say the least. And so are we. So what does all this mean? What does this history lesson mean? Well, when we come back on Life Planning 101, I'm going to share with you a very good reason to be invested for the long term, not gambling, not for luck. when we come back right here on Life Planning 101. Welcome back to Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services. If you have missed any of this show, go to www.kennedy-financial.com and pull it up. The 90 reasons not to invest in the stock market. I just gave you 90, but now I'm going to give you one good reason why. So we gave 90-year history lesson, and it was pretty dismal, really. I mean, shall you always live through turbulent times? We always have, and unfortunately, I believe we always will. So take this. If you had invested $10,000 in the S&P 500 index on January 1st, 1934, by December 31st, 2023, that amount of money would be $104,099,363. Don't you wish your great-great-grandmother had done that for you? Now, that's with dividends being invested in. Please keep in mind that past performance does not indicate future results, and you can't buy directly in the S&P. And also, that's a little long. So what I want to tell you is, what if you're 65 years old at the end of 2023? What if you had invested just $10,000 when you were 25 in January 1st, 1984, through all these tribulations we've talked about? That $10,000 would be worth $682,643. Now, I say that's a very good reason why you should be investing in the stock market. Emotionally and unconsciously, we are always thinking of reasons not to invest in the market. We are always thinking about the here and the now and the volatility and the most recent news. Is there fear today? Absolutely. There's fear for you, there's fear for me, there's fear for future generations. But I want you to think about one thing. If you know who Warren Buffett is, arguably the greatest investor of all time, you have to ask yourself, what would Warren do? He says, buy fear. So I say, let these last 90 years of experience help you be comfortable with the disciplines that you and your advisor put in place so that you can exercise what Warren does. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services. God bless you. God bless this great nation. And let's just pray for a little bit of peace along the way. Join us next week right here on Life Planning 101, where we're helping people live life on purpose.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment and advisory services offered through Smart Money Group, LLC. Kennedy Financial Services and Smart Money Group, LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.